This is NDTV, and you're watching NDTV Profit.
Welcome to Budget 2013, the Economic Matrix. Over the last 10 days here on the show, we've been attempting to bring you the economic backdrop to Budget 2013. And there's so many macro issues. We played them out for you over the last few days. Fiscal consolidation, all important in this particular budget. How do you revive growth at a time of fiscal consolidation? How do you tackle inflation? What do you do about the investment cycle? And is there any way to try and revive it, particularly from the public investment side? Where does politics fit in? Is the government going to keep a very close eye on elections that are coming up quite soon, and is that going to translate into some form of populist measures which would be built into this budget? We've talked about all of that. We've also looked at what's been happening on the taxation side. It's going to be important to see whether the right message comes out on taxation from this year's budget. We'll also have to keep in mind the external sector, the curtailing of the current account deficit, and that took preeminence in the economic survey that was tabled today as well. How do you address the foreign investor concerns and ensure that fund flows continue? Those are all the issues that we covered over the last 10 days here on the Economic Matrix. In fact, all of these issues were brought up today in the economic survey as well, which was tabled at noon in Parliament. Joining me to talk about the economic survey and, of course, all these macro issues which were built in, Samir and Chakrabarti of Standard Chartered, DK Joshi of Crisil. Thank you both so much for coming in. Appreciate your time here. We're talking about the economic survey, so let me just kick it off with that, Samiran. What did you pick up as the key points, the key focus that comes out from the survey? The growth numbers are interesting. So they're building in at best a marginal rebound, but still a rebound all the way to 6% at least next year.
Yes, compared to last year's economic survey, which was much more optimistic on growth at about 8% plus, and finally we ended up with only about 5%. I think this year's numbers are relatively more realistic at around that 6.5% mark. Even if there is a slippage on growth, that's going to be only marginal in my view. But what is not very clear is that what is going to drive growth up from 5% to 6.5%? What is the plan for reviving the capex cycle? I think that's where the economic survey is stopping short of giving us details on that. It is probably more confident on reducing the fiscal deficit bit, but looking a little bit helpless in tackling the current account deficit issue. So overall, I guess that this is more of a reflection of the macro challenges that we are facing today, rather than guiding principles of how to achieve any kind of closure on those issues.
Mr. Joshi, do you also see that growth projection as a realistic number? Although if you look at the upper end of that band, 6.7, and you look at the expected 5% growth for this year, that's a near 2 percentage point increase in GDP which they're projecting. I'm not sure under what circumstances you would get that.
Well, I think from where you are perched, I think even above 6% looks quite difficult. But I think what the survey is, we are also projecting 6.4% growth. And I think the reasons that we gave and the survey gives are quite similar. One is clearly the kick from monsoons. I mean, a good monsoon, if it pans out over a bad monsoon year, will lift the agriculture GDP growth above the trend. Second, I think they are expecting some traction from the global side, though the global situation is fragile, but they're saying that some mild recovery is positive over what we saw last year. So that's going to get partly reflected in our exports. And I think maybe these are the factors that will push the growth up. And I think here the major risk is from the nature. I mean, if monsoons don't pan out, then the growth again slips below 6%.
Are they being a bit too optimistic on their inflation, commentary, Samiran? I know the only number they've put out, at least from what I saw, is the March end number, which in any case a lot of people have been building in. But they don't seem to, show very much sort of surprise on the way CPI inflation, for instance, has been going. They're hopeful that the RBI would be in a position to cut interest rates. So are they not building in a scenario where if growth picks up, inflationary pressures could pick up quite quickly as well?
Not only that, as you do fiscal austerity, one of the side effects of fiscal austerity is that inflation is likely to increase on the back of that. So clearly the assumption here is that the demand side will slow down so drastically, or the lagged effect of the demand side slowdown will bring down prices as we move forward, or bring down inflation as we move forward, and that effect will be more prominent than the effect of fiscal austerity on inflation. But overall, I think we are also expecting something around a 6.5% average inflation for FY14, but clearly dependent on global commodity prices remaining soft, and that is the WPI print. The CPI print is likely to stay higher because don't see any chance of the food prices correcting in the near term, especially given the fact that most of that is coming from that protein-based food inflation, where supply-side bottlenecks are creating difficulties.
Mr. Joshi, your thoughts on what they're projecting on inflation? I just want to throw in one other aspect that, they seem to be premising a lot of their growth story also on the fact that there would be lower interest rates. Even when they talk about investment, they start by talking about the support from lower interest rates. If that doesn't happen, does the growth, picture that is being painted get dented?
Well, I think nobody's talking, first of all, nobody's talking of a major lift in growth here. And I think an investment revival is, I think what can happen at best in 2013-14 is some of the investment proposals that can start kicking in. If that happens, that is good for the next year. But I think in 2013-14, even if interest rates come down, I don't see investments picking up sharply. Interest rates anyway are not going to come down. There aren't going to be any deep cuts here. As far as inflation is concerned, our outlook on WPI inflation is also 6.5%, and that factors in a diesel price increase. It also factors in an electricity price increase of close to 10%. So I think even with that, you're getting a 6.5% inflation. Part of the reason is that we've seen exceptionally high inflation. The base is over the last 3 years. So I think that is also, and as Samiran was pointing out, I think our analysis also shows that there's a 1 year lag with which the core inflation gets impacted. So if GDP growth this year is 5%, I think that's going to keep core inflation, overall core inflation on the average depressed in 2013-14 as well. So I think unless there is a surprise on the oil front, I think we might see inflation coming down to 6.5%. But I think even 6.5% is high by RBI standards.
On the fiscal side, Samiran, what do you think was interesting in what was said? On 5.3, they seem to be sticking to their guns. On the subsidy side, the only thing that they talked about incrementally was LPG subsidies. That's there in a box item and in the initial text. And then they're saying that you need to focus on increasing food security. So the food subsidy bill most definitely is going to come in this time and get accounted for.
Yes, the survey seems to indicate reprioritization of subsidies from fuel subsidies into food subsidies. But let's also be realistic about it that FY13 total subsidy bill is going to be about 2.5% of GDP. The finance minister will definitely like this to go down to about 2% in FY14. So for that to happen, overall subsidies need to come down. And since whatever we are going to benefit on the fuel side is roughly going to be going up in the food side, fertilizer subsidies also need to come down, and for that urea price control seems to be on the cards. I think that will be a very critical reform to be done over FY14. Also, my sense is that during the budget presentation, the fuel subsidy is always presented in a kind of much truncated fashion. This year, if Finance Minister breaks this trend and gives us a more realistic estimate of fuel subsidy during the budget time, that will be give us a much better assessment of how good the fiscal consolidation is. Otherwise, we will end up critically looking at that number and saying that 4.8 is not realistic.
Actually, that fertilizer subsidy, we haven't been talking that much about it, but that's where you could probably get a lot of money if you do actually go for urea decontrol. But Mr. Joshi, I also wanted to ask you about the expenditure side of fiscal deficit management. We were having this discussion with Jahangir Aziz of JP Morgan, and he said, why is everybody so worried about plan expenditure growth not being there? Because there's a lot of flab on the plan expenditure side, and if that's what you're cutting, there's not a problem. How do you see the expenditure management, the drag on growth? Does it happen? Does it not?
Well, I think as was being discussed, I think he's going to keep almost all expenditures under control, or a very low growth, except for the food subsidy, which we will see bloating. And I think that is, as Samiran was also pointing out, the reprioritization of subsidies. I think he has to now touch kerosene also. I think you can't be limited to diesel alone. I think that is where a lot of flab is. Apart from fertilizers. So I think these will create space for spending on food items. But I think food subsidy, if the food security bill does come in the form that people are talking about, I think that creates a pressure on inflation, because food inflation is anyway very sticky, and increased demand for food as a result of the subsidy bill, or as a result of increased subsidy, could put further pressure on food, because you cannot raise agriculture production very quickly. So I think that could create an upside to food inflation. So I think they will have to back up with very strong measures or at least a plan to revive agriculture sector. Otherwise, I think this will be perceived as inflationary.
I'm just going to slip into a very quick break. I'll come back and discuss the current account deficit and the external sector, which also finds mention in a significant way in the economic sector. Welcome back to Budget 2013, the economic matrix. We're discussing the economic survey which was tabled today, which talks about all the relevant economic issues which form the backdrop to the budget. Let me get back to my panelists. Samiran Chakravarti of Standard Chartered is with us. DK Joshi of Crisil is with us as well. Samiran, I want to pick up on the external sector. I think you mentioned this in your initial comments. They express a fair amount of helplessness on what they can do on the current account. They say that the potential to increase exports is not much. So then what? We just keep tinkering with imports, and that also just on the gold side?
Yes, that seems to be a pretty difficult challenge in front of us, where this current account deficit issue is becoming more and more structural. To some extent, it might sound perverse, but if investment picks up in this country, then actually the capital goods imports might come down, because I think that part of the capital goods import is happening because of domestic suppliers not being able to supply enough. Also on things like coal, etc., part of the increased demand could be because of coal mining not happening at a fast pace here. And similarly, with iron ore mine bans, the iron ore exports might have also come down. So what I'm hinting at is that if we kind of get out of this investment slowdown situation, then to some extent that will help us reduce the current account deficit. But having said that, yes, there are no overnight solutions to this issue. Maybe even we should try for a somewhat weaker currency to address this issue, but a currency which is more stable than what it is today.
Also, Mr. Joshi, as it links in, economically speaking, into the savings investment gap and the savings problem, I think there's a box item which talks about financial savings, why they've been falling, why money is going into gold, and hence, worsening the CAD. Can we anticipate that something would come in terms of encouraging financial savings, to whatever extent a budget can focus on that?
I think so. I think there could be some encouragement in terms of some incentive for pushing financial savings up. I think high inflation has discouraged them, so I think inflation coming down should to some extent bring people back into this segment. But I think budget can also because of high inflation, even the limits, exemption limits have become irrelevant, because I think in real terms they have actually come down very significantly. So there might be some more tax incentive related to savings. That's what I believe. I think beyond that, the budget doesn't have any leeway.
Okay. Let me talk about, one thing that's been actively discussed and will be discussed at the time of tomorrow's budget presentation as well, as to what role elections have played in all of this. Some would call the food subsidy bill, a tool of populism. Others would say that it's the direct transfer scheme. Standard Chartered had done a very interesting analysis, and since we have Samiran here, I just want to put that up on screen. Elections and spending. So in the early years of a government, a stable government, you tend to see relatively lesser increase in spending. 1999 1991 to 96, 4% increase, but in the last 3 years there was a 3.6% increase. But if you look at the subsequent governments, 1999 to 2004, there was a 2.8% spending increase in the first 2 years, but a 9% increase in spending in the last 3 years. And then the 2004 to 2009 government, there was a 1.9% spending cut in the first 2 years and a 14% increase in the last 3 years. Samiran, very interesting analysis and numbers that you'd put out. But this time around, do we have that trend continuing? Do we have the room to have that trend continuing, given the kind of fisc that we're facing?
Well, first to clarify, the numbers that we are quoting on spending growth are on real spending growth, so it's adjusted for inflation. If you add inflation to it, the nominal spending is much higher. Having said that, I think about a 12% expenditure growth for this fiscal is still possible, given that Finance Minister is most likely to target about a 15% revenue growth. So that kind of a combination is what I call the middle path, where you are not doing an excessive populism, neither are you going in for excessive austerity. So in my view, Finance Minister is going to treat something of this middle path, and with this kind of a middle path with 12% expenditure growth, it is possible to put money in for some of the flagship schemes. You are not in a position to start a new scheme or start something like a farm loan waiver like last time around, but you can still possibly say that National Food Security Bill will be given a token allocation. You can still possibly say that the other flagship schemes of the government, be it NREGA, be it the Sarv Shiksha Abhiyan, all these will get their required allocations. So that, to my mind, would be the best way to approach this year's expenditure side. Clearly, in a pre-election year, cutting back very sharply on expenditure is not possible. What I'm worried about a little bit is that in the process of garnering revenue growth of 15%, can the Finance Minister spook the financial markets or industry by raising taxes in some form or the other?
Mr. Joshi, two parts, following what Samiran said. One, I'm curious to know what would people term as populist measures. So if the food bill comes in, would that be a problem? If they go ahead with this benefit transfer scheme, would that be considered election linked? And the second aspect, of course, is, in terms of whether they target the easy targets like the wealthy and say that, okay, we're just going to raise taxes on them and try and garner money there because they are not our target vote bank.
Well, I think first of all, I just want to point out that the austerity will depend on his aggressiveness on the fiscal deficit front. I think if he manages to get 4.8% with the kind of revenue and expenditure growth Samiran was talking about, I think that should be great. But if he becomes more aggressive and brings the fiscal deficit target down to 4.6 or any such number, I think then you have a situation where I think he'll have to cut more on expenditures because revenue raising scope is very little. Now, as far as the food subsidy scheme is concerned, I think it is definitely at the timing of it is, one can say, is it is targeted at the electorate. But I think it is needed. But I think, do we have the wherewithal to fully launch the food subsidy scheme? Because you'll need more food stocks. I think the demand for food could go up if implemented effectively. So I think there are issues there. But yeah, I think this would be one spending which would be with elections in mind, I think. As far as the other part is concerned, I think taxation, etc., I don't think he can afford to spook the financial markets at this juncture, because we've already seen so much of issues with taxation in the last 2 years. I think he's probably going to manage a stable tax regime. At least in this budget, I don't see much tinkering with the taxes.
All right, I'm going to have to leave it at that. All of these questions that are unanswered right now will be answered by about this time tomorrow. Thank you both so much for stopping by today, helping us analyze some of the issues that have been brought up in the economic survey. That's all the time we have on this show. Tomorrow, big budget day, full coverage here on Profit. Do stay with us. Thanks so much for watching.